All right, guys, for those who are outside, come on in. Bring a drink, bring a snack. For those in here, thanks for coming in on time. Let's make those guys outside feel bad. But hey, thank you for joining us again. For those who've been here all day, thank you for hanging out for this event. Let me introduce myself. My name is Roy Hansraj. I like to say I'm a strategic advisor for InsurTech New York. I've been with those guys for a while, or a long-term intern. Also part of Zurich, running their strategy for North America. But today, let's talk about corporate VCs in insurance. We have a whole agenda for you today, but we got to get some logistics out the way first. Pretty much. I want to thank Jason and Manchester Story for sponsoring this event. So thank you. Round of applause. Thank you. With that, we have a couple other events going on this week. Upcoming. Thank you so much.
Next few months.
There you go. Yeah, we have our events in AI solutions for insurance. This is out of San Francisco and the San Francisco Bay Area. This is the first event that's really looking at partnerships with plug and play. And why I think this one's pretty cool, because they're actually doing a real debate on AI and claims. So I think that's an event to go see. We actually have real master debaters out there that are really going to go over the topics and really get a real discussion going on. So that's really exciting. We also have another event coming up, which you guys should know. It's next year in March. Our big event of the year, our spring conference. This one's on AI and analytics. Now, this one's our 5th annual event. That's pretty big. So everybody who attends gets a gold watch. No, Tony and David won't do that for me. However, we had great feedback from our venue at Pier 60, and so we're doing it there again. It's going to be very exciting. It's not as big as ITC Vegas, but it's intimate. We have about 1,000 people, and that's just enough. Like, we act like family. We say hi to people, and then we all decided that, you know, when we have a family feud night with some startups and InsurTechs and insurance companies. So that's actually an event there. So we have a lot more fun stuff for that. If you haven't registered, go to the site. And then by next week, they should have an email with a discount code because you showed up here. Right, Tony?
Yes, we're going to send everybody an email with discount code. So, yeah.
Carry me on, Tony.
All right, sounds good. So there's a lot more events that are happening. Obviously, we talked about the San Francisco event, which is the last event we're hosting this year. We're also the spring conference, but look at all the events we're hosting next year. So we have about 7 public events we're hosting, including a ski slopes event in January, and then other events in New York, Las Vegas, and San Francisco. We also have executive roundtables for our corporate innovation program members, and so on Gen AI investment and running a pilot, mastering the pilot. And any of you who are startup founders in early stage, like idea on a napkin or very early, if you make more than 250K a year, you're not eligible. You're too mature for our competition, okay? So you have to be very early stage. If you are, please apply to our competition. Our application will open in January. And the finalists will get to pitch in front of our audience. And then, yes. Sound underwriting, yes. So
Great question.
Thanks for asking. So this year, with partnership with Jason and George Lewis and Susie and Risha, now at Arch, we did a art of distribution, okay? So we're gonna switch it up and go sound of underwriting. We're gonna basically have some musicians who are in the insurance industry, and then we're gonna talk about underwriting. So that's basically what it is. Should be a fun event, so hopefully you can come to that. We'll share more information. By the way, if any of you don't know or any of our events, subscribe to our newsletter. Go to our website. We'll keep you updated on everything we do. We also have Accelerate MJ Lab. We're going to repeat it next year as well. Applications for that open probably around May timeframe. So if you are interested in joining any of these programs, or if you know friends who might be interested, please share with them.
Awesome. Thank you, Tony. So today we have a lot of things going on, but we have 2 panels we're going to host today. Let's go through our checklist. We got the doors open. You guys had great networking, right? Did everybody get to talk to everybody yet? We got another time to do it. So we have another session for networking. So let's check 4:30. We did welcomes and introductions. Let's just get to our first panel right now. With that, running a CVC as a financial investor. not exactly a marathon, but more like a choreographed dance with like jazz hands, I think. So let's just introduce our panel right now. We have Steve, who runs the World Innovation Lab for Tokyo Marine. He's a founder. He was a former founder of Metro Mile, and he's also raising some runners. He has 2 kids who are runners right now, right in college. We also have Brian. He's an investor at Cameron Ventures, an early stage VC. He's a sales and go-to-market kind of guy at heart. But outside of that, unlike me, he's an avid runner and recovering D1 athlete. And he just ran the New York City Marathon this past weekend. So give it up to Brian. We also have Jason, we just introduced. Besides having an award-winning bow tie collection, he's currently the vice president, head of platforms for Manchester Story, who accelerates the engagement between insurance carriers, brokers, and InsurTechs. With that, we also have David, of course. Do you have you guys not known David? If you don't, you're probably running into trouble this morning, but he's been going at it early this morning. With that, that's our panel. Over to you, David.
Thanks, Roy, and thanks for all of you that have been on the treadmill with us since 8 a.m. this morning. I know many of the startups I see in the audience were actually up here on stage pitching themselves. So the fact that you stayed around must mean that something important is happening up here. So we're going to try and have a very interesting conversation. So just to give the context, really, from my perspective, there's 2 types of corporate VCs that exist. There's those that are purely strategic and mainly invest off of the balance sheet, and they're going to say, you know, you need to run a pilot with us, you need to get a business unit champion, and then after all of that, we'll invest, which is not a bad thing because they'll become a customer. And then on the other side, you have those that are represented up here, which is they essentially have sat in the role or have, you know, LPs that sit in the role where they have a dedicated fund and they think just like a traditional VC. They're out there making investments and they want to have returns on their money, hopefully on par with any other traditional VC. So we wanted to have a discussion about those 2 different types. And I thought, you know, between Jason and Steve and Brian, that we could really get a deep discussion about all the different pieces of that. So why don't we start with Jason, since you've kind of sat in between both sides, really, you know, at EMC, the kind of balance sheet side of things, where you had the opportunity to be almost purely strategic, and now sitting on the opposite side at a traditional fund that has some LPs that have dedicated funds. So how did you come up with your thesis at EMC, and how should CVCs think about their thesis?
Yeah, thanks, David, and happy Thursday, everyone. So wonderful to see you all. And I'll even back up a little bit further, because I may even say that there's 4 different types of CVCs, because some of the larger carriers have a separate CVC that are really all about, you know, the venture return. Yes, they may invest in this space, but they are often separate from the business unit. And sometimes way out ahead of the business unit. I won't name names, but there are some that, you know, are more of a traditional venture fund. Some CVCs in the corporate space are very much about the strategic investments, but they have a dedicated team, they have a dedicated fund that's often set up outside of their regular balance sheet to go out and make those investments, here again, of a strategic nature. The third kind is what we had at my last carrier role, which was EMC Insurance, which was we had a sleeve approved from our board of directors to go out and do strategic venture investments. And in that case, as you alluded to, the thesis was very much around the strategic part. So we would only make investments in early stage companies that we either had or intended to have a commercial agreement with. But that was doing so, and a lot of it was really not so much motivated about the venture level returns. Yes, we want to get our money back. Yes, we'd like to get a multiple on that. But it was really as much of anything about their strategic value, where we felt that we could not only add value to that founder and that team, but they in turn could add value either to some part of the insurance value chain or to our distribution partners or to our end customers. Now with Manchester Story, which is an early stage InsurTech, FinTech, health tech firm, similar stage as what I was doing before, Series C, Series A. But most of our capital, most of our investors are insurance companies. So we, across our funds, are backed by 24 insurance carriers, brokers, and wholesalers. And in many ways, for many of them, we are kind of the equivalent of a CVC. So across those 24, maybe a third of them have dedicated investment team members who go out and do investments. Maybe they invest in multiple funds, they invest in multiple companies, maybe even looking for acquisition opportunities. On the opposite end of the spectrum, about a third of our carriers that we work with, this is their one and only venture play. Like, they are so conservative, they've never made any alternative investments hardly at all. So this is their way to not only put some of their capital to work, but also really get the strategic value by partnering with a firm like Manchester Story. And then the middle third is kind of in between. We're probably their only fund, but they are also making strategic investments. So they're also looking for us to be that extra set of eyes and ears for deal flow, for recommendations and insights as well. So when you look at insurance carriers out there, founders, there's a lot of different flavors, and it's really important to understand, where are they coming from? How are they structured? Because that might also make a difference as to how they can help you grow your companies.
Yeah, I think that gives a good deeper level perspective, kind of the 3 or 4 different worlds that you can sit in. But I think, Steve, it'd be good to hear, since you have essentially kind of 2 different investment groups, the WIL and Tokyo Marine's kind of dedicated fund. So how are those divided up, and what's the stage that Tokyo Marine chose, and why, and then how is that different from your bigger fund?
Yeah, and it might help to have some. So I come at this a little bit differently, in both as a traditional VC starting out, but mainly with a operating background. So I'm bringing that perspective to things. I'm going to date myself a little bit, starting in, for those of you who know the history of InsurTech, back in the 90s, was part of the very early team at RMS, was the first product person there, built that business up. Spent the 2000s actually with my boss from RMS at a company called Assurion, helped grow that from, when he pulled me in, a few $100 million of revenue. When I left, 6 years later, we were doing about $6 to $7 billion in revenue. So if you think about the growth phase over that, when people talk about embedded insurance, you can thank them for every time you walk into a Verizon store and they try and sell you an insurance product on your phone. Every time you try and check out from Amazon and there's an extended warranty product, that is all the same company that's doing all of that. And we built that business. And from there, going and starting Metromile. So from the 0 to 1 stage of how do you actually build a business. So coming in with that, and with Will, traditional multi-billion-dollar asset management organization, multi-stage fund, investing on behalf of 30 plus LPs who all happen to be large Japanese corporates. So doing very traditional investing. And so here with Tokyo Marine, the way it worked was they were one of our long-term LPs. Obviously, with my background in insurance, it was they approached us and said, would you like to partner with us to do our CVC? And they're obviously, convincing to, let me go focus on this, work with them. There had to be a common vision around how we were going to do this. So we set it up as a single LP fund. So it's traditional, carry structure, everything you would look at it. And then balancing their vision for, hey, we want to invest early stage. We're a big Japanese company. It's going to be hard for those companies to partner with us. So it was very much about help us get insight into where insurance is going to go and where our customer is going to be over the next 5 to 10 years. How is the behavior patterns changing? How is mobility changing? How is climate affecting what our business is going to look like? And so really thinking about it from how can we get strategic insight into where the world is going around us? How can we anticipate that? How can you help us do that? And really coming in with a focus of, let's invest from a financial perspective, but let's think about from the lens of, we know these early stage companies are going to be ready to partner with us. So how can we be helpful? And so that was kind of the way that we agreed, let me jump in, work with them, do this. It was much more the reverse of, when we're investing in a very earlier stage, how can we leverage the 12 companies that Tokyo Marine operates in the US to add strategic value early on, with the expectation that everything we put in, we're going to drive financial returns and accelerate those, but also the strategic benefit will come over time as these businesses mature, and then can engage with the company as we move forward. So that was the philosophy that we brought to putting this together.
So Steve, I think I can thank you very much for making my Amazon 1 click actually 2 clicks, because I have to press no every time I don't want warranty on, my $10 electronics. So Brian, we've heard from Jason about how VCs can be structured, and from Steve about ultimately how they can help, right? They can either invest first and then help, or they can help first and then invest. You're very much thematic, and we've had this discussion a few months ago, that you have some ideas on what's really going to work. Like open insurance was one that we talked about. How do you come up with some of these themes? And other than open insurance, maybe you could share another one that's exciting you recently.
Yeah, for sure. And I think to give an anecdote and how strategic can play with financial as well, is we often ask our business units what it is that they're looking for in the year. And we refresh this every year. We come back to the heads of innovation and we say, what is keeping you up at night? Like, what are some things that would save you money? What are new products that you might need in this new future of AI, for instance? So when we come in the investment theme, I'll reference as workflow automation. What are some of the tools that we could use? Like when it comes to open insurance, we think, well, maybe we need to download documents from an AMS, right? And that's a manual process. So maybe we can go find a technology that can automate that process, or at least help alleviate the bottleneck of putting all that information and entering it into the AMS manually using a human. We develop those themes across all the sectors that we invest in outside of insurance as well, so that when we come to the table, we've already developed some kind of thesis on where the market's going to move or what product is really needed. More often than not, if our carrier needs it, then other carriers will also need it as well. And we can validate that by talking to Manchester Story or talking to Tokyo Marine or MSNAD or any of the other slew of InsurTech investors out there.
Well, now that I know that document workflow automation is important to you, I might want to point out some of the founders still in the audience. Like I see Doc Lens there, Lazarus presented a little earlier. We had OptimalX. So maybe if you rewind and watch some of the presentations earlier today, you can find a couple that you like or at least want to research. So we're talking about the easy stuff, how are you doing what you're doing and what the focus is. Now let's get into some of the tougher questions, and Jason knows that I can't let him escape a panel without at least one tough question. So,
Remember, turnabout's fair play. I will be moderator the next time.
all right, I like that, Jason. So the first tough question of the evening is for Jason, and to be fair, he had a little bit of time to prep on it, but one of the fears that some of the startups in the room or others that are not in the room have is, if a CVC is going to invest in me, or even a fund that has a bunch of carriers' interest is going to invest in me, how do I make sure that their end objective is not to just buy me later? What can I do about that? Or is that even a legitimate fear?
I would say for the most part, like if that's a fear, then that's probably not as legitimate, because in many of the cases for all of you, those carriers might be a really good exit opportunity for you. And I'll mention a little bit, because we've even had one of our investor carriers acquire one of our portfolio companies. I would say if there is any fear on the carrier side at times, it always used to be, if a carrier's on your cap table, does that mean, am I enriching my competition if I become a customer? And so I always used to advise founders, if you're going to take money from one carrier, try to get it from at least two, because then it looks like you're backed by a consortium as opposed to just one. But I also think some of those fears have been a little bit, unfounded. Because at one time, I remember going back, 6, 7 years, a lot of founders looked at carrier money as like, oh no, we don't want to take that, because we don't want to be beholden. We're trying to, of course, change that industry. Why do we want to take money from them? And I think a lot of folks have realized, no, these carriers actually recognize they need and want to change and want to help and work with partners and founders who can help them ultimately deliver a better product service to their customers and their policyholders. We did have one, like I said, a third of our carriers that invest in us are doing so in part for deal flow because they are making independent investments as well and also looking for acquisition opportunities. So we had one founder come in and one of our insurance carriers, Great American Insurance, acquired them. It gave us over a 6x return on our investment in just 22 months. I would take that every day, and most founders would too. It doesn't always happen that way, but I actually think that it's important to understand, like I said earlier, who you're taking money from. And most of us and most of the carrier investors in this room, actually raise your hand if you're an investor, just for our founders to know who all here is from a fund, and how many of you are also with carriers that could also be customers. Quite a few. Yes, there's always who can write you a check, but so often it's not just who's going to write you the check, it's also who's going to help me bring in those insights, bring in the other resources and help us grow our companies, because that's what we're all looking for.
Yeah, and one we just saw last week, Travelers bought Corvus, so I'm hoping for many of the investors that was a something X, maybe not quite a 6X, but a something X. So Steve, given that you've spent a lot of your time on the operator side, maybe picking Metromile specifically, did Metromile accept any money from carriers? And did you have any concern that those carriers might one day have an auto unit that may have some level of competitiveness?
No, and Tokyo Marine was actually an investor in Metromiles. It's one of the ways that, I developed that relationship with them over time, and there were multiple carriers that were investors. And I think the biggest thing, and maybe flipping back to the Tokyo Marine example, one of the big things that I need to educate, and I think people at startups need to think about and be very cognizant of when they are taking investment, is there still is a little bit of if we're going to make an investment, let's get some exclusivity to go along with that. And that is just, poison to a startup. And so I am constantly doing hey, if we're doing investments, if any senior executive across one of the companies says, oh, let's try and get some exclusivity along with that, it is no, we're not doing that. And do the education as to why. And even to the extent of, it's very funny, I know some of the MSNED people are out there. Tokyo Marine and MSNED are very competitive companies. We're all good friends. We like hanging out. We're like, let's do deals together. Some of the, the corporate people are like, wait, if they invested, should we be investing? It's like, no, we're in this together. And I think, we've been very cognizant of trying to use our relationship to help kind of change the mentality of kind of this exclusivity, zero-sum game versus, hey, let's help some of these startups be successful together. Let's not, do things that are going to limit their growth. We should be looking at ways that we're helping to accelerate their growth. And that is an educational process that we need to kind of consistently do within kind of the corporate partner as we're doing these investments.
Amen. No, really, I spent 20 years on the carrier side. I'm still relatively new to the VC side. I always thought there was like a lot of competition. Yeah, we might compete on a deal, rarely. We're much more likely to co-invest on the next deal. I think I helped, 4 founders in the last year and a half get investment that weren't a good fit for us. But we talk and we share deal flow because we're all in this, at the end of the day together. That's a great point, Steve.
Yeah, so it sounds like really if you're pitching, I know John and Tiffany are here from MS&AD, you might as well give it a shot with Steve. Maybe one of them will work
together after this, probably. I mean,
yeah, exactly. So definitely take advantage of the kinship that they have, and but heed Steve's point, right? Like ultimately, if the investor wants to put clause in there for an exclusive or something that makes you feel uncomfortable, you should just say no. Like you ultimately have to do what's best for your business and not just take a deal. But maybe this leads to my question for Brian, which is that it's not very common for CVCs to lead rounds. So I'm kind of curious, like from your perspective at Cameroon, does that limit how you feel that you can be as an investor to get the allocation you need? Or how do you view that kind of in the market?
Yeah, and We don't have ownership targets at Cameron Ventures, so we like to try and fit into the Jenga of putting it together around as much as possible and kind of be as friendly to the founder as possible, where in most cases, we'll actually scale back our check to allow another carrier in or a partner like Manchester Story, because we know a rising tide lifts all boats, and it's better for all of the carriers to be customers rather than just us. And to your point earlier, we've also had executives say, oh, we want exclusivity on a deal. And we will usually tell our founders that before going into the sales process so that they keep an eye out for it. And then we'll do the nudging on the back end to say, hey, this isn't something that we should be doing. We're going to handicap this company from really hitting the potential for their growth. So it really depends on the CVC. I mean, there are a couple that are, I'll call more institutional than they are corporate, and they've either spun out from their parent company and have raised outside capital, or have the leeway to lead rounds from the get-go. And for them, ownership targets are important, but I would just pull that back to general venture strategy. There's a lot of ways to make money in venture. You can lead, you can follow. There's no one way that really works. It just depends on who is, I guess, at the helm of the CVC ship, so to speak.
Yeah, no, I think it's really helpful to just, understand each of your CVCs and, see where they sit. So maybe back to Jason is, since you kind of shared you like being in this kind of cordial environment and you're surprised on how cordial that it can really be. One of the complaints I've heard from some startups is maybe in their pre-seed or seed round, they took on some money from one of those evil West Coast generalists that wants them to grow faster than they feel more comfortable. Is that something that scares you, sitting in Des Moines when you see a Silicon Valley generalist investor on the board that you maybe don't see eye to eye with, and is that going to prevent you from getting in the deal, or do you have a way to help, level set with the existing investors?
We don't see that quite as much, to be honest. But we are typically Series C, Series A, so more often than not, we're some of the first institutional money in. About 80% of our capital has been deployed as a lead investor. So we actually love to roll up our sleeves and not only help do the due diligence and set the pricing and the terms, but then also whether it's taking a board seat, rolling up our sleeves, because really at that early stage, let's face it, a lot of founders don't always have the cleanest cap tables. Maybe they've done some bridges and some notes. There have been so many times where we, as as an investor, as a lead investor, which thereby oftentimes a board seat, we see some of our role as helping our firms get to the next growth stage, to that next raise. And oftentimes that's helping them with their financial model, helping them clean up their cap table, helping them do some things that aren't always a lot of fun, but we are really good and we've had a lot of success helping our companies get to that next stage. And let's face it, a lot of founders, that's not your background. You're entrepreneurs, you're trying to solve tech problems, whatever it is. And so having some good partners who can also help you through that, I think is really important. And most of the folks in this room that raise their hand are going to do the same thing.
Maybe don't be completely afraid if you took one investor that didn't work out, because Jason will work with you hand in hand and clean up your cap table.
And I think it's less of an issue of them coming in and forcing growth that's too fast. Most of the generalist investors I'm working with are putting in good practices. They're helping put in good governance. They're helping good advice as much as they can. The biggest challenge I see with them is, oh, good company, I want to take the whole round. I'm not going to leave any room for anyone else, and I have to kind of convince people to put money in. And there are several deals where they've been like, oh, CVC can't add value, push them off to the next round. And the entrepreneur is the one that's saying, no, I absolutely want them in. And we've gotten in, and it's quickly transitioned to, oh shit, they're adding so much value. Steve, can you come to all our board meetings, please? And gone exactly the opposite direction. And I think it's from our perspective in operating as a CVC, there's an onus to prove you can actually add the value you say you're going to add. And if you can do that repeatedly, then you're going to build that reputation, and then you're going to be in a position where other good investors are going to invite you to that cap table with them, but you have to prove that you can actually walk the walk.
Yeah, so I think that's maybe a good point for all the founders is like, you should do the diligence on your investors as well and ask them what value are they going to add for that small seat at the cap table. So, Steve, given that Metro Mile went through the full cycle to go public, do you think the consideration of the participation of investors is different? Like, if you want to or have the aspiration to go public, do you need to have a VC on the cap table that recently had an IPO in the last 24 or 48 months?
Well, no, because you're not going to find a VC that's had an exit in the last 24 months because there haven't been any. But I mean, I was having a conversation with one of the founders here earlier on about, particularly in the insurance space and looking at things, there are multiple paths to a successful startup. They don't all have to be, I'm going to raise VC, I'm going to get to, 100 or $200 million in revenue, I'm going to exit as an IPO. If you look, going back in 5-10 years, that was the exception, not the rule. There are plenty of ways to build a great company and have a great exit. Do you want to build a lifestyle business that's going to throw off cash and build a lifestyle for you? Do you want to do something for the next 5+ years, sell it for $100 million, make $10 to $15 million yourself? As a really easy exit. There are lots of ways that you can be successful as a founder. There may be differences in what capital you want to take. There may be something you're building a great business. It may just not be a venture scale business. There may be a different set of investors. There are lots of paths to an exit with your VC investors. I think you should be open to a lot of different things. I'm starting something, I'm going to exit at a $3 billion IPO and I'm going to make $500 million. That's a realistic set of expectations for people to have, and that's the only thing that qualifies as success. I think the most important thing is getting investors with you that are aligned with what you want the business to ultimately become. And if you get those right partners, then you can work together. That's the most important thing, I think.
Yeah, I mean, totally agree. And I think a lot of times I see founders so caught up in the end of the journey and they're not enjoying the journey while it happens. I mean, if you live in the now a little bit, you'll definitely enjoy every day of founding the startup instead of just looking for that exit. And it's probably going to be a better life for all of your employees as well. So, Jason, given that Steve kind of teed you up here in terms of, some startups want to have a venture style exit, what are the expectations if you took a standard Series A company? What's kind of a range of entry and what type of, multiples are you looking for? Or you'll send them home to be a lifestyle business.
Yeah, and I appreciate these guys' perspectives as well. I think, for early stage seed A, I think it's pretty standard. We underwrite to 10x. So if we don't think that there is an opportunity for 10x, we're probably going to underwrite the check. It just doesn't make underwriting sense, knowing that some of them will go to zero and hopefully some do better. But all of us in our investment memos, we run the probabilities. What is the percentage probability that this will go to zero? What is the probability that this will return, 0.5? What is the probability this will return a 1.0 and just give us our money back? What is the probability this will be 5x? What is the probability 10x? And we try to run those models to figure out how we can get to an aggregate 10x. Because, that's what venture capital is. And not only for us, but for our investors is to be able to return that level. Later stage, B and on, yeah, we have a lot lower expectation. But those checks are also a lot bigger as well. And the fact of the matter is some will go to zero. But I think all of us too are, really about helping our founders. So we had one, it was going to go to zero. The board, the investors were all fatigued. I think everyone was ready to walk away from it. We helped, get 70 cents on the dollar because we saw a lot of value there and we helped negotiate, and find a buyer for the IP. So we got $700,000 back on our $1 million investment. Losing $300,000 sucked. But it sucked a lot less than losing $1 million. But because we stepped in, everyone got those 70 cents and, and the founders got something as well.
Yeah, it was great that you were able to save the day. But for the founder last week that sent me their financials, it was 9.7x return. I'll make sure to send it back to them and figure out how they can get one more contract in there.
That's right.
So, Brian, given that you kind of have an interesting setup of being kind of family office driven for your investment, but still being kind of a CVC, how do you benchmark yourself as an investor? Do you benchmark yourself against any other VC? So like when I look in the Cambridge Analytics like vintages, is that what you're comparing against, or do you have some other benchmark?
Yeah, absolutely. I'd say we start with financial returns. We're a top quartile fund. We want to stay there. We want to get better and maybe enter the top decile. And it's because we benchmark ourselves against everyone else that our portfolio companies succeed and that our operating companies succeed. And I'll get to the strategic side of things where, we advertise ourselves as focusing mainly on pre-seed through A, and early stage investments. But selective, we can look at, B and beyond. And we've done pre-IPO deals before because we've seen significant strategic value and strategic opportunity where we could become a multi-million-dollar customer or contract. Or it's so key to our distribution strategy that we need to have a piece of the financial upside. And that's when the family office kind of hybrid structure kind of comes in. And it's a lot harder to quantify that. We have a pretty good hit rate, I'd say, on commercial opportunities, about 20% of our portfolio. We have some kind of commercial relationship or distribution agreement or something like that. But of course, the strategic leads into the financial where that is a piece of our underwriting so that if we have the inside baseball and we know that we could be a pretty big customer, helps us de-risk the valuation a little bit and get more comfortable there.
Yeah, no, it totally makes sense. So we have time for 20 seconds for each. So we'll start with Steve, Brian, then Jason. What is one piece of advice that you want to leave the founders here with to ultimately present best to CVCs?
I mean, specifically presenting best to CVCs. I mean, understand the business that you're presenting to. I think you being able to walk in with both the, hey, here's how we're aligned, but also think about it from the perspective of, okay, what strategic value are they going to extract from me? Think about it from the perspective of what can they deliver? And I think I advise this with my founders with every board meeting you're going into. To some extent, your board works for you as much as you work for the board. Walk into every meeting with a set of asks for what they can do for you. Working with a corporate, with a CVC, you should be doing the same thing and setting up that relationship at the beginning of what can they do for you as part of this relationship and align on that before you start.
I'd say, first of all, it's a really tough fundraising environment out there. So the first thing that we want to hear, especially on the strategic side, is how are you going to save us money or how are you going to make us more money? That is by far the easiest way to start working with us on the commercial side. And then if the commercial side gets really engaged, then the venture side gets really engaged.
And along those lines, we saw 40 great companies and 40 good to great pitches. So all the founders, get a really tight 3-minute pitch. Get a really tight 3-minute pitch. What are the 3 or 4 things that we as investors and as carriers want to know? How are you going to help us grow the top line? How are you going to help us on the bottom line? Because really what you're trying to do with that pitch is get us to be excited about a next meeting. That's all you're trying to do with these pitch competitions is get to that next meeting, intrigue us enough. Some of you did it a lot better than others. And if anyone would like feedback, ask any of us. I think we're all really happy to give feedback and advice as well. Don't be bashful.
So there you have it. Get to really know the CVCs before you pitch to them. What's the ROI, top line, bottom line savings, and really get your 3 minutes done well. Like, we're a resource, so all 4 of us are here happy to help you with your decks. So thanks, everyone, and I will pass it back to Roy to invite the next panel and thank our panelists.
Thank you. Give it up to the panel, please. Thanks, guys. So that established the crawl, walk, run model. The marathon. Thank you. Thanks, Rob. All righty. Quick introduction of we have a lot of events going on. We're going to push through. If you want to get a drink, just come right back in. I'm going to tell you about some of the other events we have going on there. It's centered around founders as well as InsurTechs and investors, really including education, networking, and outdoor building. We have these 2 events coming up in January, slopes and all. All righty. I'm going to keep pushing through, guys. Get the drink. Come on back. All right. I'm going to introduce our next panel as we get started here. The next panel is what wins, incremental innovation or big bets? It's really understanding if it's a slow and steady race like a tortoise or a really quick here jumping forward. With that, let me introduce our next panel. Coming on, and of course, we have panels with two people with the same name. Adam C. Is part of Stony Brook as an SVP and joined Stony Brook as an SVP in April of 2022 and leads the origination and executing corporate finance transactions across Stony Brook platform. He started his career as Deloitte & Touche, covering insurance companies, banks, and then Societe Generale. And also, give a round to Adam. He just got engaged this past week. That's a big thing. Last night. Congrats, Adam. Well, at the end, the drinks are on him. Okay. We also have Adam B. of Blumengrens. Adam is currently a partner at Distributed Ventures, an early-stage venture capital firm. He serves also as a board director of many companies. I'm not going to go through them. There's a lot. His investments and insurance expertise are rooted in industry spanning as an investor, a lawyer, and a broker. Prior to Distributed Ventures, Adam worked with insurance brokerage, a subsidiary of NFP. He's also a fellow alum of GW, like Tony and myself. Very cool. And of course, there's Tiffany. She's part of MS and AD Ventures. She's a partner there in investments, but she's also based in Silicon Valley and a leader in the CVC space. She has the most active investments, 100 plus, if I got that right, 100 plus portfolio. And she's also the person to hang out with in big InsurTech Vegas conferences to get tchotchkes. There's also James. He's the head of America for News Content at the Insura and leading P&C industry in trade publication. James is responsible for breaking news in every part of the sector. He began his career as a reinsurance guy at Guy Carpenter and also routinely interviewed senior leaders in every part of the major companies. With that, let me pass it over to James. There he is. Guys, you can come on up. There you go. Thanks, James. Tiffany? It might work. Guys. James.
So a lot of this conversation is essentially about the conversation that people have had in the industry about InsurTechs going from being disruptors to enablement. Hopefully, we've got people on the panel who've got very different views and we can spark some conversation. I guess just starting with you, Tiffany, how would you describe a company? How would you define a company as a big bet and why?
Sure. So, at MS&AD Ventures, we have both financial as well as strategic goals, right? And so when we're looking at a investment, we want to underwrite for venture returns. So, things that are what we call I like to call big market bets are things that can scale to globally. It's a massive company that can be, multiple billions of dollars.
Do you guys, is that essentially how, would you agree?
I completely agree. I have nothing to add. I generally agree. The one tweak I'd make is that Distributed Ventures, we too are returns driven first and foremost with a strategic edge based on the relationship we have with our anchor LP, NFP, a large retail broker, which I guess you got during that introduction. We too are looking for big bets. I think most investors are looking for big bets. The thing that we've learned, and I think we'll get into an example at some point in time, within the industry, if you're selling technology to insurance incumbents, you can't wake up one day being day one, and say, I'm this big bet and come buy my solution. I think a more realistic approach that a lot of these big bets are going to take is start out as an incremental innovation and then continue to add to what they do, Trojan horse their way into a bigger bet. So I agree with Tiffany. It's all about the big bets, but I think there are ways for companies to start out more incremental innovation and then move to bigger plays.
Do you think the industry has changed based on the lessons learned from some of the big prominent InsurTechs that came out a couple of years ago? Obviously there was Lemonade, Root, whoever else, Hippo, that, we're talking about disrupting the industry. What's your sense of how the perception of big bets has changed? Has the venture community been humbled by some of the experience of InsurTech the last couple of years, or and there's almost people are afraid to talk about big bets, and it's just it's an easier thing to talk about evolution than big bets.
I can go again. Yeah, 100%. You've got to be more patient. If you come out of the gate swinging, I mean, even if you wanted to do this, good luck in this market, but you cannot raise an exorbitant amount of capital. You cannot let your valuation run away. For most businesses outside of high margin SaaS businesses, you're an insurance business. And I don't care how cool the story is. I don't care how impressive the founders are. 9 out of 10 times you're going to trade based on how more than that, 99 out of 100 times you're going to trade based on how every other insurance business has traded historically. Yes, there are some learnings. You have to be more patient. The reality is, even if you weren't patient, again, good luck in this market. As everyone is well aware, we're not in the most active, especially on the later stage growth end of the market, venture market, at least compared to where we've been over the last five-ish years.
I'll maybe add
You
some.
don't have a microphone.
No, we can share it. So I know, and I had like a handwritten name tag on here walking in, so thank you very much for the attention, David. Yeah, I mean, I would say too, like the expectations of raising enormous amounts of capital, valuation, the companies that have went public that are InsurTech, how they've changed, how they've not. But I think with all of it, it's like there's still a lot of innovation that's like yet to come, right? So like there's from 2012 to 21, there's like whatever it is, $40 billion of money coming into the space. Like that seems like an enormous amount. The insurance industry is like 6 trillion of premium. So it's like, those are like basis points. So it's like, if you really think about it, yeah, there's been a lot of change, some of it pretty good, some of it not good, but there's a really long way to go. So if you say like that 40 billion is R&D for a $6 trillion industry, it's like, all right, cool. There's still a lot of runway and a lot of really cool, unique ideas. But to Adam's point on, if you're a full stack, full stack, if you're an insurance company, you're going to trade at book value. There's no tricks you can do. It's just what's going to happen, right? So go ahead.
So I think, to be fair, it's not just the InsurTech industry that got hit really hard. Right? You take a look, there's several industries where, well, except AI, right? AI is just going off on its own world, but fintech got hit very hard. Everything just kind of came back to just the basic fundamentals, right? So if you started, like, I don't know, investing and building companies 3 years ago, you have this baseline. But for, I've been doing this type of work for 10, 15 years. Like, it's just going back to normal, right? I've been in the insurance industry for maybe about 4 years, and one of the things that I really like about the InsurTech world is that it's a very small community, and it's generally quite supportive, right? Most of us know each other already in this room. So I think what we really need to do is challenge ourselves is, what do we want to grow up to be, right? You already know the insurance comps. Those are not new, right? Do you want, and you know what a SaaS comp looks like. So the question is, what, as innovators, as creators of companies, as investors, right? What are the expectations that we have out of the InsurTechs that are being born? Are the ones today, are they going to shut down? I mean, a lot of them are going to shut down for sure, right? Do you stay sort of a niche solution? You're just serving the insurance customer, or do you want to grow up to something much bigger? Right? All those things are questions that we have to ask ourselves. And what is expected out of this industry? Because right now, all the tourist investors have left, right? And everyone else that's left, that's like still around here, this is what we have. This is our community. So what are we expecting out of a InsurTech? What's a fast-growing InsurTech?
Just ask you guys a question, going off script a little bit. It seems like if you think about some of the companies that are publicly traded, they're a lot of very personal lines focused. They're struggling, and even sort of the major mid lines carry.
Doing a little better though, recently. Give him some credit.
Who are you invested in? Yeah, exactly. I personally spent a lot of time in the cyber world talking to a lot of cyber folks in the cyber community. And to me, it seems like there's some big bets there that actually are kind of in the process of playing. Big bets are playing out as successes. I mean, obviously, there's still some dislocation. Cyber market conditions have softened. But I think a lot of people would say that was sort of a big bet that was probably worth making. I mean, do you guys have an opinion on if you were to make big bets today? Is there, I mean, assume the cyber market maybe has got a little bit saturated. But is there anything that stands out to you as that's a pretty bold idea that I want to back?
You want to start, Tiffany? You want me to go? Yeah, sure. Why don't you guys make that point, and then I'll make the counterpoint just to keep this fun.
So I would say like I'm going to answer it a little. So I'm not really going to answer your question. So sorry. But what I'll say is, so like from my experience, like I'm talking to, I know it's a good way to answer it.
Proposes to his girlfriend. All of a sudden he's got this confidence.
So from my perspective, so I talked to a bunch of the big cyber carriers, startups, but that are later stage that are doing $400 million of business. So a lot of them were these, MGAs that turned into full stack carriers and all that stuff. So we're working with them not really on the capital raising side. So I'm a banker, if that's not clear. I'm not a venture capitalist, so I'm not as cool as these two. But so we're working with a lot of the cyber carriers, and so not necessarily capital raising, on how do you capitalize the carrier with surplus notes and things like that. So, but what I think is interesting is I agree that they are getting to kind of an interesting point in their growth trajectory, becoming pretty real, right? And taking some market share, but there's probably still quite a bit that they need to do from their own kind of growth. But I think they are getting to of size that's, they're having interesting conversations with reinsurers and stuff like that, and how much capacity they're going to get and all that stuff, which is pretty important. But yeah, so that's kind of just my perspective on it. I don't know if that was helpful or not, but I figured I'd mention it.
That was fantastic.
So we do our underwriting on, first and foremost, the founders, right? The world is always changing, and what we really care about is, we literally would ask the founder, what do you want to do with this company? If it's sell for $300-400 million, it's not that interesting for us.
You can call me, not Tiffany.
Yes. That's true. Yeah. So we want to underwrite for big bets. So we it's very easy to say, oh, well, I don't want to invest in InsurTech because it's bad right now, right? And then you kind of eliminate maybe 80-90%. But Uber was stupid until Uber became Uber, right?
I was just going to say, it's not even a counterpoint. There's two ways to think about it. Tiffany's fund has their approach. My fund has a different approach in that we're going to take less bets, more concentrated bets, own larger positions in these businesses. And so we make the math work. If you own 15 or 20% of a $200 million company, the distribution's meaningful. If you own 2% of a $200 million company, Tiffany's point, it's not meaningful. So that's another point worth bringing up. Know the fund you're speaking to founders now, and ask their math. And if they're not willing to share all of their math, fine, but they should share enough where you understand what's important to them and how it aligns with your journey, point one. Point two is, this is counterintuitive. I was looking up here because I don't even know if this is technically a part of the script, but the other thing to think about is, James, you're 100% right. There's only, and Tiffany's made this point too, there's only so many big bets. And a lot of investors, big bets is important. You as a founder should also be realistic with yourself. Do you even need venture money? Do you want to get on that flywheel of every couple of years potentially having to go back out to market just to stay alive, as opposed to being a little more patient, growing a little slower, but not needing money to survive, A, and B, owning a big chunk of your business. So if you ultimately sell for even $30 million, which is not exciting for any of us, including myself, but if you own a majority of that business, that's a big payday. Something else to think about on the other end of the spectrum of big bets.
Yeah, the interesting thing about the insurance sector is there is capital here. right? Unlike other sectors where you know, maybe venture capital makes a lot more sense. Insurance actually, there's cash here. There's capital to put into like reinsurance or just building an MGA where you actually don't need venture capital dollars.
Well, just to kind of pick up on kind of what I was asking before, I mean, to what extent do you think the InsurTech community is chastened based on sort of the experience the last couple of years around taking big bets, but also how opinion has changed in the last couple of years in terms of what big bets are worth taking? I mean, there was obviously a trend for a little bit where it's like everything's going to be D2C and, you know, there's a lot of money kind of piling into that. And then suddenly you have these InsurTechs go through the agency channel who are having success. Do you have a sense that how people in the InsurTech community are thinking about big bets has changed?
I think it's harder. I don't know. You know, it's just harder. There are just, I think, less big bets out there purely within the InsurTech industry, which is part of the reason why I've said two things today. One is we've adjusted our math accordingly, so we could make $300 to $400 million, potentially even $150 to $250 exits work, which is maybe more realistic for some founders, not only in this room, but across the industry. I'm really dodging this big bet question and like bring it back down to like non-big bets, but it's the truth. And it's the other reason why I said big bets are tough in the industry. And so it's why founders should be realistic about, do I even want venture money? Maybe get some friends and family and call it a day. Yeah, that's my 2 cents.
I mean, I think, you're seeing like White Mountains and Bamboo. I mean, it depends on like what big is, right? So like to some degree, private equity, like, it's still like there, right? It's just, the price at which that trades is probably a lot different than what you'd expect. But maybe as just like I would say like maybe the entrepreneur's expectation of a big bet that they get, a cash out and, they buy a Ferrari or something like that. I think that's changed probably for the better. Like we did a project this company was doing, it's like a TPA. And if I say any more, I'll probably reveal who it is. So TPA, do $1 million of ARR. Guy flies me down to Miami, rents out the penthouse. Let's talk about the project. I want to sell the company $50 million. I was like, it's just not going to happen. And whatever. We get to we work on the project, get some bids on it. It's way underneath that or whatever the number was, and I think like at that point just like had a realization like the market is telling you one thing, and regardless of what our engagement letter or what your expectations are, that is what that's what's available. Take it or leave it. And so we ended up stripping out some of it and kind of doing like a bit of a spin out. But I think that story, this year or, later last year changed. I think, that's kind of important, right? So I don't know if that's helpful or not, but.
Extremely.
So actually, if you think about like venture capital, the characteristics of what venture capital is supposed to be, and then you take a look at insurance, they're like opposite personalities. Right? Like even if you're a MGA that's growing like crazy, your reinsurers are like, hold on, like slow down, right? And so actually, like if you really want to have a big outcome in insurance, I think being patient, understanding that this is a very long game, and do you have the stomach for it, right? I think it's very important to ask yourself.
That's a good point. The other thing I was going to say, you reminded me, Tiffany, is that, and now I will make a big bet statement. I come from the brokerage world. That's my background. Longer story for another day. But so I usually gravitate towards what I see in the brokerage community. And what excites me about the future of InsurTech and the potential for big bets going forward is if I go to a lot of my broker friends that I've known for a while and ask them how much of their life has changed over the last 5 or 10 years, most importantly from a technology perspective, 99 again out of 100 times, they'll say this much. And so that to me is like, okay, we've got some cyber MGAs that have been exciting and a couple other ancillary businesses that have done well, but there is still massive opportunity to improve, innovate within our massive industry that, for whatever reason, from a tech perspective, is still outdated.
And I would add just one more thing too, like on the big bet piece, like, it's another $100 billion loss year. So like a lot of it's like refocusing back on core business too. So like, am I going to take a flyer on this new, it's like maybe it's just out of season for some of that, right? If you're like a Midwest Mutual and you got hammered and you put a 140 combined ratio and you see this, fancy piece of kit, then you're like, I mean, I could see where it makes sense. I also put up 140% combined ratio. So I got to figure that out. And if you are in the audience and that's your story, call me anytime you need.
Well, do you have a question or I could? So the other thing is actually like as an investor that I spend time looking at are just things that are actually just outside of insurance, right? There's an insurance core like a MGA, but like what is insurance about? It's about resilience, right? Is there something in the prevention space that's interesting? Something in the remediation that's actually making life easier, better, faster for whatever problem we're trying to solve?
I don't know if audience questions are part of this format, but if anyone's got questions, feel free to fire away. With that, we'll get back on script. So Adam C., this question's for you. You work closely with InsurTech Gateway, which almost exclusively invests in new products and MGAs.
I'll stop you there. You're going to get me in trouble. IA Capital's right here. I work with IA as well. Christy she's fantastic, and she should be up here at some point.
Let me finish the question.
Sorry.
Is new distribution a big bet on the future of the industry?
Sorry, I talked over you, so I didn't really hear the question.
Is new distribution a big bet on the future of the industry?
Yeah, I mean, I think so. Strategic venture capital, most of your LPs are insurance companies. A lot of what they want to see is different ways to distribute their products. I mean, that's kind of obvious. And is it a big bet? Yeah, I mean, you could do it a bunch of different ways, and to some degree, it doesn't cost as much, right? And so the methods and means of getting a product to you, getting it through an agent easier if you rely on independent agents or direct, obviously is hugely important, and it's helpful to grow. And is it a big bet? Sometimes it's a bunch of medium bets that equal something that's like super significant, right? So if you're working with like a digital broker or some agency tech that's like making it easier for some of these independent agents to choose you versus the other carriers that they work with, like, yeah, it's a huge impact for you, and it will benefit you kind of over the long term.
I think in the prep for this panel, we were trying to pit Tiffany against Adam as sort of you being the big bet investor. You focused on sort of incremental investments, which I think you kind of resisted a little bit. But so you guys have invested in Ascend. What is the big bet you are making is going to change in payments, and why?
So first of all,
you can push back on anything.
yeah, I was just gonna say that I'm also into big bets, but I also think that you could start, and I've come from this industry, so I appreciate the nuance in the industry. I just think it's very realistic to assume that you don't just wake up one day a big bet. You start off as incremental innovation and get there. So I want to make that point. I'm on both sides. I'm hedging my bet. Ascend, yeah, Ascend is one of our favorite portfolio companies. All of our companies are one of our favorite portfolio companies. It started with the founders, Praveen and Andrew. I don't know if anyone knows them. Just fantastic individuals. Very data-driven, very urgent, which is important. No matter how much money you raise, you got to hit the ground running in this industry. You cannot waste weeks, months, years. You can run out of money very quickly have very little to show for it. Point one. Point two is financial operations is a nightmare for retail brokers and MGAs. Most retail brokers, I want to say all, that's probably true, but again, to hedge my bet, let's say most retail brokers and MGAs are not good at financial operations. And it was something that we've been talking about with NFP for years. We found a team that we think could solve that problem, not only for NFP, but all retail brokers, all MGAs. At the time, premium finance was a big part of the story, still is. But what's changed over the last couple of years since we made that investment that I think has made the story an even bigger bet is that interest rates have gone up. And what's interesting is 20, 30 years ago, brokers used to make more dough than they have over the last decade on the float through agency bill. That's been non-existent. It's very difficult, I think, for a broker to take advantage of that on their own in this market. Ascend's a tool that can make that happen. So we're very excited to see that come to fruition over the next little while.
Outstanding. Any audience questions?
Thank you.
We got some hands. Is that Gabe?
Hey, how are you?
Good, thanks. How are you?
Great. Good to see you guys. A portfolio company that is not in your portfolio, what is the biggest success that InsurTech has produced? And how are you going to recognize the next one that comes along?
Can't say hippo.
Sorry.
Tiffany, you first.
Your question was your question was what insurance company? It's an InsurTech. That's the next big market.
A big success that we missed, and what's the next one?
Well, the biggest success that InsurTech has produced, period.
Oh.
It can't be a portfolio company. And then how are you going to recognize the next one that comes along?
All right, so I'll say a lot of the cyber MGAs, Corvus been in the news, Coalition. I'm not sure there are too many, and this is part of the issue right now. There's not too many distributions, exits, liquidity events that we could talk to. Corvus, obviously, recently. Coalition's a good story. A lot on the cyber side. So a lot of stuff, and James kind of alluded to this before. A lot of stuff that we look at when we're thinking about how big of a bet can this be? What kind of return profile does this potentially have as far as our funds concerned? We compare to, hey, is this going to make a market the way cyber MGAs did over the last 5 or 6 years? So that is 100% a barometer we still use. In terms of how we plan to identify that next company, I don't think there's any secret sauce to that. I think we continue to do what we've done historically as venture investors, which is focus on the team, focus on the market, focus on the timing. Maybe that's a really big lesson over the last little while is you can have a fantastic team, you can have a fantastic market opportunity. If you mistime it, you lose. Nothing else matters. So I think ensuring that when you're putting your dollars in, this company's at an inflection point, and cyber was at that inflection point.
Only asking questions.
Answering this question, Insurance IQ was like over $2 billion by Prudential. So Insurance IQ, right, was purchased for over $2 billion by Prudential. So the investors there did very well, and Prudential didn't necessarily do well. But I would have answered like Guidewire or Duck Creek, right?
I think success, at least from a VC perspective, it depends on when you got in and when you sold, right? Like there are some investors in 2021, they had like 20 unicorns that year. And then if they didn't like somehow sell or secondary out, like this year kind of sucks because now your portfolio is all marked down, right? So I think there's nuances, and a lot of this stuff is not public, right? So just even with Corvus, right? Maybe some of the earlier investors did well. Was there a liquidation preference? I don't know. I didn't do the deal, right? Like I could speculate. My guess is some people didn't make a lot of money. Some people got their money back, and maybe some of the earlier folks made a lot of money. Don't know.
I'm actively working on it. We've gotten a lot of inbound on that actually, and trying to figure out what to do with that.
Another question over here. I guess maybe the flip side of that first question was, or in my opinion, I'm in the consumer space, so probably a little different than a lot of people here. But for the big consumer companies that went public, and we've seen stock prices over the last 5 years, a lot of them don't look so good. Are there learnings that you could almost advise to some of us getting into that space to avoid, or maybe like something that we might not know about the insurance space hypothetically that's daunting?
Fantastic question. I'm not going to say anything you don't know. So I'll tell you that right off the bat. But what I will say is I think that a lot of great consumer businesses are going to be built right now because they've learned from, like, the reality is those businesses so far aren't successful. I think that the story isn't over for most of them. Some of them maybe. They, number one, went public too early. Number two, they didn't focus on unit economics because at the time, that's not what was important. Now it is. I'm sure you are all over your unit economics. So it's not the fact that a business is a consumer business. It's the fact that they were not focused on unit economics, and that was the time when it was growth at all costs. So point one. Point two is non-consensus businesses over the long run in this game are usually the ones that provide the biggest returns. So as counterintuitive as it is right now, I am all for a good consumer business focused on unit economics, the right team, the right approach. So again, I preface it by saying I'm not going to say anything you don't already know, but kudos to you. I think you've got the potential to build a nice business in the consumer space.
Hey there, Evgeny Alexandrov, founder of Pilebird. The question is bringing back to insurance, right? You talked about cyber being big bet over the last 5 to 7 years. What are you solving for now for the big bet in insurance over the next 5 years? What are you looking for in a big bet? Are there certain segments, themes that you're solving for a big bet?
I hate this answer, but AI. I hate this answer. But I spoke before you spoke, so AI. I'm grandfathered in. But it's not AI the way you think of it. I'm not just going to say AI, period. Maybe I am. AI, period.
I have a question for you. If you,
But I will say there's a business out there. There's public information. There's a company out there that's an MGA focused on ensuring AI-related risks, and there's a lot to that. And there's an argument that you can make that this is the next cyber frontier. It's got the potential to be even bigger. No one outside of little Munich Re product exists out there, so you could make that argument for sure. All right, so I said AI. What do you guys have?
So I would say I'm going to go in a completely different direction. So, which I guess I've just been doing this whole time, so I don't know, good or bad, but yeah. So I would just say, like, I mean, writing E&S business, right? So, like, seeing a ton. Fine, plug. You guys do a great bit on that on your.
No,
It actually is good.
the choir on E&S.
I would say like E&S, like we're seeing a lot of, and I just see that time went out, so I'll try to be brief. But yeah, like E&S, like California, non-admitted homeowners, Louisiana, this, that, and the other thing. I mean, it's kind of exciting. You're getting an enormous amount of rate. Yeah, so I know the time's up, so I'll let you go. E&S.
What else you get hit with one bad storm that first year of your book?
You got to write good, profitable business.
Our thesis has not changed. We've always invested in data-driven companies, regardless of what sector they're in. We think understanding the data is very important. That's why if you look at our portfolio, it looks like it's all over the place. But we are actually looking at the core of what we're looking at is actually the data set. Because if we think you can control the data set, you can understand risk very well.
Question for another day is, if you have AI in your name, how much of a valuation bump is that worth? I'd love to know that, but that's all the time we've got. Yeah. Or it's just it's every MJ is an InsurTech these days.
It's like all the crypto that pivoted into AI.
That turned out well. By the way, thank you to our panelists for participating this evening. That's all the time we have. Thank you.
Thank you, Adam. Thank you, everyone, for staying back. Just one more thing. Hey, thank you all for attending. Just a quick reminder, we have our 2024 Spring Conference. You should get an email next week, so you guys sign up with the discount code. With that, I want to thank you all for hanging out. There's still networking going on. Thank you to David and Tony and our staff. Thank you all for attending. Cutting this short so you can get the drinks.